Welcome, everyone. I think you thought that I'd be gone, but no, I live virtually, so I am still here with you tonight, at least briefly. Of course, Professor Starn is going to be taking over the job of discussing the world of bond analysis. He's going to be talking about coverage ratios and the risk of default. But I wanted to take a few minutes to discuss what I'm going to be looking for in your term paper. And then I'm going to talk about the weekly lessons and the assignments and how they really come into play when you're going to be doing this paper. So why don't I start off by talking about that and see if I can get my little magic pencil going. Who knows? Oh, I'm going to miss being able to use that while I'm sitting with my shoulder in a bloody sling. So this is the last time you'll see me get to do this. All right, so here's what I'm looking for. Is a description of your company. Again, like I said, when you look at Mergent, you have a wonderful description there, and if you combine that with the 10K, and of course you can always pull up the company's annual statement, and you're going to be looking for outside sources as well. So you'll have plenty of material to be able to talk about both the company and, even more importantly, its outlook. What is it looking for? Both as the company itself, along with the industry that it belongs to. You should clearly, of course, make some effort to take a look at the company versus its competition. So if you can pull up some ratios, some growth projections, and some commentary that contrasts your company from other companies, that would be very, very helpful. And just as if you were doing a SWOT analysis, you want to be able to take a look at the risks. What are the dangers that are confronting your company? If you've got an international company, obviously you're going to be taking a look at some of the dollar issues that are going to be going on and the GDP. Given the assumptions that we're looking forward, that we're going to probably see some rising interest rates, we may see some flattening of the GDP, so we're going to take a look, and we might even see some changes in legalities. So if you're doing some work on in the world of medical marijuana, who knows? Maybe it's going to not be eligible. Boy, I'm going to knock on wood. So you want to talk about some of these things. Then what you're going to do is take the initial data that you pulled down from Mergent. This was the starting point. And I asked you back in the beginning to pull up this data to run a quick analysis of the data using the ratio analysis that I sent to you, to pull up some of this stuff and talk about what do you see today given the initial data. So I want you to do that because you're going to be then talking about a contrast as you go through with the revisions. So you'll then talk about what revisions did you make and what were the impacts on these same ratios. So by this point, you've already done a recast income statement. You've calculated the effective tax rate. You've modified your balance sheets, and as you've gone through and made any of these changes, you should make the changes as well to your balance sheet, to the liabilities, and to the asset portions of your statement. And you're going to be wanting to add to this supporting documents, supporting material. So the analysis you've done for lease conversion, any pension obligation analysis, fixed payment schedules, depreciation schedules, an analysis, say, of the retained earnings, what's going on when you're looking at a comprehensive shareholder equity review, those sorts of things that we're going to be looking at. In week 7, I'm going to be talking about what we call a prospective analysis. And what that does is it takes all of these updated statements and it uses those as a starting point to project out over the next 5 years. So this is really the world of the equity analysis, equity analyst. So you're going to be taking all of the data as well as your expected returns that you just would have done based on RNOA and ROCE analysis. And you're going to move these forwards. Okay? So using that data then, you will be able to provide a new set of 5-year statements, 5 years of future income statements. We're going to keep them broken out, of course, by operating, non-operating, and recurring returns. We don't know what's going to happen with the extraordinary items. So, I don't know if a company's going to declare an impairment. How can I know? So those are the things that you won't worry about. We're just going to focus on the operating aspects, but you will want to take a look at recurring and focusing on the recurring events, whether they're operating or non-operating. We'll want to look at these. We're also going to be using that same data then, when we're done, to do valuation. I'll also talk about this in week 7. We're going to be using an approach that you learned in both 591 and in 593. It's going to be focusing on the free cash flow to the firm, FCFF. That's kind of consistent with return on investment applications that we did in 591. So we're going to be looking at things with respect to that. And then what you're going to do is summarize your findings at the end of the paper as a bond analyst and then as an equity analyst. You don't have to make projections based on, I think this is a good investment, because I find that to be really quite bogus. What I want you to do, though, is to give me, as a bond analyst, is this safe? Is your company safe? Is your company not? On a continuum, you had to think about your weighted average cost of capital, because you used that when you did the capitalized lease conversion. So you might want to think about that. What is your company rating, if it has a bond rating right now, and do you think that that might deteriorate or improve? In the same way, as an equity analyst, your real focus is to say, okay, what are the risks? What is the intrinsic value based on all of this material? What's really confronting the company? What would you look for going down in the future? Okay, so that's what I'm looking for from the paper. Oh, where's slide 2? There we go. All right. So this is not quite as pretty as I had hoped, but I've sent to everybody these slides so you can be taking a look at your own copy. But this is kind of a quick review of what we've done from week to week, so you can know how this all goes back into the project. This, I don't know how that snuck in there. It just snuck in there. Okay, so in week 1, this is what we talked about. We talked about the company, the history of financial statements, these needs of finding external data. We talked about ratios and the DuPont especially. We also used that just this last week. So you want to make sure that you're running a DuPont both on your initial data. You're going to be using the DuPont again on your recast data down here, and you're going to be using these analyses when you contrast them with your findings when you're looking at just operating assets and the return on common equity. I also asked you to give me compound growth rates, trend analyses on sales, income, all of these issues. What are the key issues for your company, the key numbers that you would be looking at? So you would give that to me. In week 2, we then started to tear everything apart for the next 4 weeks. And we started with income statements. So I asked you to rebuild your income and think about it in 4 areas. On the left side is going to be recurring income using operating, non-operating data. On the right side I always think of it as the non-recurring things, the things that you can't forecast. Things that are either extraordinary or unusual, which can go up here, and then extraordinary and unusual, which are completely out of left field, which kind of comes down here. So you're going to be breaking those out when you're doing any kind of prospective work. Although you might want to take a look and check again in your 10K for contingent liabilities. These are the things that aren't going to show up in your data, in your spreadsheets, because you can't forecast them, but they might be there looming around the corner. Okay? So you want to know this stuff. And I also wanted you to analyze the tax statement so you have a pretty good idea how to create an effective tax rate for your firm. Okay? In week 3, we then looked at assets. We talked about going from LIFO to FIFO and mark to market on these things. We talked about the LIFO conversion. So if you have inventory, you want to focus on that. Some of you don't have much inventory in your company. Others, say with a Costco, have a lot of inventory. So you're going to want to talk about what they've done. Was there a need for a LIFO conversion? Is that required? I also want you to talk a little bit about depreciation, any goodwill analysis. What is the company doing? What are the risks of impairment? Has impairment been an issue in the past? If it has, remember, then you need to always go back because you need to focus on what are the implications of the impairment on your financial, on your profitability analysis. Okay, so you want to make sure you've cleaned up everything for these things, since impairment always just messes up everything. I think it's a cheap way to start all over again. We also talked about the operating cycle. You're going to talk about that, and you're going to come back to that when you talk a little bit about cash flows. From the standpoint that, remember, the company's operating cash flows should be sufficient to keep the lights on and to keep widgets in production. That's part of that operating cycle. It's the working capital, and it's the cash needs that are going to go on in the company, because external cash needs that you're bringing in, borrowing, or should be used for other purposes, for the growth of the company, not to sustain the company, but for future growth. So you're going to look at that. I also want to make sure that you're providing me with common size statements, both in assets and in liabilities, and then in overall capitalization, along with the trends of the common size. Again, is there anything that's really standing out? Remember, I looked at that for Microsoft, and that's where I could take a look to say, okay, we've got a lot more emphasis on debt, long-term debt. This is what management said. This is what management has done. And then when I took a look at the overall capitalization, I could show you that indeed shareholder equity, retained earnings have gone way down due to share buybacks. So that's the purpose of the common size. Okay? Of course, you should always take a look with your revised income and revised balance sheet statements then, if you have any changes to make, then to see, do we have anything going on? Or is turnover being changed? Is utilization being compromised? Liabilities, we get the same thing again here with the common size. Just remember that when you're looking at the right side of the balance sheet, you're going to be focusing on liabilities alone when you're doing a common size. And then you're going to be taking a look at kind of the aggregated areas of liability combined with things over in the shareholder equity portion to look at overall capitalization. So you're looking at debt versus capitalization. We talked about off-balance sheet issues with liabilities. contingencies, pensions? Do you have anything with SPEs? I don't think anybody did. It isn't such a thing anymore, but you wanted to make sure. Obviously, the conversion of operating leases into capital leases. And I think more than a couple of you have had to do that. So you then also need to understand the weighted average cost of capital. And we talked about how to kind of use that, look at this whole schedule of bonds and maturities, and then take a point that's kind of reflective of any kind of contingencies or of this conversion process, and get an idea of a realistic interest rate. This last week, we looked at cash flows. We talked about how we converted cash flows. You know, where does everything come from? And I reconciled these cash flows to say, do they come from the income statement? Did this thing come from changes in working capital? Did it come from elsewhere in the balance sheets? Or did it come from the comprehensive shareholder equity statement? You know, where do the cash flows come from? Because you really need to know that. As much as I kind of backed off from my old 591 statement, the cash is king, cash is still the crown prince. You want to understand where everything comes from, and you want to know where it's going, which is why I also recommend that you go through the common size process for your paper to separate out sources and uses of cash. And that way you can get an idea and compare the two. Where's the cash coming from in the company? How's the company using it? This is where I found that Microsoft is using its cash to just keep rolling it over, to keep buying new, more and more very near-term investments, as opposed to putting much stuff into the future growth. Like I said, it's kind of this hyperbolic discounting that I hate to see from a company. And that gave me that conclusion. We then finished the analysis for week 5 by, again, taking the DuPont using the recast income statement, and then going beyond there, calculating out NOPAT, net operating profits after tax, and then using that as the driving element along with the effective tax rate that you've calculated to come up with a return on net operating assets, so that we can say, how is their company really doing on its truly invested capital? Is it using its capital? Or, like we saw in the case with Costco, are they using other people's money? OPM, which meant that they really don't even need to use all that much debt. We looked at the leverage. We decomposed these returns again, and we really got a much better idea of leverage, where we think that leverage in the normal DuPont, is sufficient, and we found, no, there's a big difference in leverage being used for future growth or being used to just simply appease shareholders, like we saw with Microsoft, where they're using leverage to buy back stock. It's a one-time deal. It reduces your shareholder equity, but what you're going to do for the future growth? You want to look at that and understand that, because it's going to have serious implications. I think that when I look on my return on common equity, and I see numbers like 20-30%, but then I look at the fact that they're just not really funding, then I'm going to have to say, I'm going to scale this back a bit. I think that, as I think about this as a true analyst, I'm saying, this kind of smells funny. They've got great returns on what they're actually doing, but they're generating so much cash that they can't put the money back in and make it return as much as they've got from their operating assets. It's like looking at internal rate of return with that bogus assumption that you're going to be able to continue to get returns each year, these past returns, on any subsequent cash flows. It may not work that way, but you want to understand it. This week, when you're looking at solvency, you're going to be looking at coverage ratios. You'll be looking at it from the perspective both, again, of your recast income statement, and then you're going to be looking at it from the perspective of the cash flow or the operating cash flow statements. So you're going to want to be able to do things as an analyst that way. And then you're going to talk a little bit about Z-scores. Is your company at all under any kind of risk? And then, like I said, in week 7, we're going to project. We're going to take all of the material we've taken to date, and we're going to project it out so you can do valuation. I will be sending out a spreadsheet or an integrated set of spreadsheets that's going to give you an idea. The only thing that won't have my integration to it is going to be that prospective analysis. I want you can see the format, the template, but you got to do a little bit of the work. So you'll get an idea of how to do that. And then, of course, in week 8, we're going to do the presentations. And what I'm going to do in week 8 is I want to have 2 of you kind of grading each presentation. I want you to be thinking critically about the things that you hear and any suggestions, recommendations that you're going to make to the presenter, because you still have another week that you can actually finish up your paper. So we're going to be taking those recommendations, putting them back to the presenter, and making sure that everybody does the best job they possibly can on their papers. Okay? So this is where we've been, this is where we're going, and this is the reason that we're doing it. So I will be seeing everybody in 2 weeks. Like I said, I will be looking at your material online. Just because I can't be in the office doesn't mean that I have to be out of your lives. So thank you all, and have a good week. I'm sure Professor Starn will take care of you, and be nice to Professor Starn. Good night.